Okay, let's bring in Anupam Manor, Professor of Economics at the Takshashila Institution. Welcome to you. First of all, how quickly will removal of the European industrial duties, do you think, be reflected in the quarterly earnings of the major US exporters?
Thank you for having me on the show, Neil. I honestly don't think we will see it in the quarterly earnings. The premise here is that EU industrial duties were a meaningful wall for US exporters, but they really weren't. The EU's tariffs on US industrial goods were already extremely low, about low single digits, while the US is now charging 15% the other way. So removing them isn't really a step change for US companies exporting to Europe. It's a couple of percentage points change at best, and that can easily be overcome by exchange rate movements. As you mentioned slightly earlier in the show, the dollar is strengthening, and that can wipe out the gains from the removal of tariffs. Change in EU-USD exchange rate either way can move the advantage. So the effect of this will not really be seen in the quarterly earning calls of the US companies. The duties coming off were small, but when is still a big question. The benefit, however small, will flow through with quite a bit of lag, as it does with most things to do with trade. You will have existing order books, inventory in transit, and hedge contracts. So realistically, a quarter or two before anything shows up in realized margins. And the bigger number to look out for, of course, is the tariffs on the other way around for European exporters, not really for the American ones.
Now, the European Union holds a sunset clause. I mean, this deal could be gone by 2029. So, do you think it's going to be a long-term fix for the trade imbalances, or is this just a sticking plaster?
That's a really interesting question, and if you will allow me the liberty, I think I want to get into a little bit of macro 101. A tariff deal really cannot fix a trade imbalance. There's no structural fixes here because tariffs aren't what causing the imbalance in the first place. Imbalances from a macro perspective come from savings, investment, and capital flows, right? So the US runs a deficit with Europe because it just consumes more than it saves, not because Brussels has a tariff wall. So this deal doesn't really rebalance any of this. What it does really is buy predictability and take the worst case tariff war off the table. I would almost look at it as a managed de-escalation between the two parties because it's about managing tail risk and removing uncertainty. And notice that the EU has deliberately built in a 2029 expiry date, as you've said, but also multiple suspension clauses and safeguards. Basically, they've designed this as conditional and something that can be reversible because they know that it's a managed de-escalation and not a settlement. And you know, in this case, the world will not really blame the European Union for it because, and it's funny for us to say this now, but the United States is just not a trusted or a reliable trading partner, right? The president can impose tariffs for entirely different reasons, which is outside the purview of the settlement.
Yeah, not a trusted trading partner. That sums up the last year, I think. What about the European automotive sector? I mean, 15% tariffs could have been worse, but could be better. Can manufacturers absorb such a significant margin, or is it going to really squeeze their profits?
Yeah, the automobile sector is going to be hit, and a little bit of context here helps because the tariffs on automobiles actually went from about 2.5% before the trade escalation to 15% now, which is really a big jump. And it only looks like relief now because the threat was of 25%, right? So in effect, though, it's already a big jump, right? So let's say the German premium automobile makers, they have essentially three moves. One, they pass some of it to American buyers, and American buyers have the purchasing power, so they can absorb it. And history shows that a lot of the tariffs that the US has imposed has, in fact, been absorbed by the American consumer. The second move, to a lesser extent, is it eats into some of its margin. That will happen. But third, and I think more importantly, is that many of the German car manufacturers are already building inside of the US. So BMW, Mercedes, Volkswagen, they already produce inside the US. So a lot of German cars sold in America are actually already made in America. And those would escape the tariff walls entirely. So the real squeeze is on a smaller percentage of European-built cars which are US bound. And they will, I think, as I said, they have to either absorb it or push it on to the American consumer. The one way to look at this is that the tariffs are actually acting as an industrial policy magnet, right? It's trying to pull production into the United States, not so much settle a trade dispute.
Yeah, I mean, that seems that way, pulling production to the US. Fascinating analysis. Thank you so much. Anupam Manor is my guest.